Welcome back, everyone, to Vox Markets. My name is Paul Hill, and I'm delighted again to be able to speak to Jamie Constable of Singers, one of the UK's finest capital markets experts. So welcome, Jamie.
Thanks, Paul. Good to be back.
Yeah, well, lots been happening over the last month, but there's really been one sort of story in town, which is the Ukraine-Russia conflict. But can you just give your thoughts on, one, how long this is going to last, and more importantly, how it's going to impact the global economy and inflation, which are already pretty elevated levels?
Yeah. That's the billion-dollar question, how long it's going to last. I mean, the signs of light, we're recording this on Tuesday. I think we need to say when we're recording this, because who knows what could happen in the next 24 hours. But obviously Putin yesterday saying, if you give me Crimea and a couple of republics, I might actually take a step back. He must be taking a lot of pain on the ground. So a sign of light there. What does it mean for markets? Obviously, we've seen what it's meant for markets so far. It's meant oil price has gone up from 92 to 125. Gas prices up an exorbitant amount. Wheat's up 72% year to date. Nickel, well, currently suspended trading after a 250% price spike. This is all fear of the unknown, though, because despite all the sanctions, everything that we're here, we're still buying Russian oil, we're still buying Russian gas, and we're still buying Russian aluminium. So the sanctions are there, they're on individuals, but we're still buying it. If we get a resolution, whatever it might be, then prices will go down as quickly as they've gone up, because it's the uncertainty that's killing markets at the moment. And we all know, and we've heard it many times before, not just from many people, it's uncertainty that kills markets. So that's what we're seeing at the market at the moment.
Okay. So let me just butt in there. So apologies for that, but let's just assume, for instance, that Putin isn't showing us all his cards, which is probably not a bad assumption. And actually, his ultimate goal is not to find a resolution. It's basically to rule Ukraine from Moscow. And if that's the case, then you're going to get unrest in Ukraine for years, simply because most of the population are against, obviously, an autocratic state, and they want a democracy. So under that scenario, that auspices, the Western sanctions are going to be in place for a long time, even if the military problem doesn't spread out. So on that assumption, if it's going to be some significant quarters, this effectively sanctions in place, what does that mean in terms of the response by central bankers? Because they could actually, it was easy last time. They just printed a lot of money and just did helicopter cash for everybody. But now inflation's already at 7, 8, 9, increasing percent all the time. So what can they do?
Well, I think if it's going to be like, taking your scenario, take that as the scenario, then we probably will stop buying oil from Russia, and we will stop buying gas from Russia. So those prices will remain high, and we'll have to find alternatives. What can central bankers do? Well, the EU apparently are going to issue massive loads of bonds, a huge bond issue to invest in alternative energy and defence. So we're going to see a lot more spending on alternative energy. And that effectively is what central bankers are doing. I'm sure the question you're asking is, what are they going to do with interest rates, though? What's going to happen on interest rates? I think they have to move in the short term, because they can't be seen to do no actions on the basis of inflation moving up like it's moving up. So inflation, could it hit 10%? It could do. I mean, you wouldn't be surprised with what's happening with the oil price, what's happening with the fuel price. Everyone can see it when they put petrol in their tank. Prices going through the sky on that. So they will have to move. So 16th of March, we'll get 25 basis points from the Fed. It's not going to be 50 now, much as we wanted 50 before. There's no argument to do 50 now. And then the 17th of March, you'll get 25 basis points from the Bank of England as well. Then I think they'll sit back and see what the effect on the global economy is, because what causes downturns, recessions, is loss of confidence. It's confidence that's what kills it, and that hits demand. So what is key now is, what does Ukraine mean for global corporate and consumer confidence? And that's what we have to take a measure of out there. And you can ask yourself that question, are you going to go out for meals still? Are you still going to want to go on that holiday? Are you going to buy that big ticket purchase of a car or whatever? Well, you won't be able to get a car at the moment. That's kind of even worse to get a new car now, because a lot of parts are made in Ukraine. But anyway, what are you still going to do that? If you are, then if the majority of people are still going to spend money, then that's a positive. The flip side for that is the squeeze we've got on consumer disposable income from the increased prices, whether it's fuel, whether it's car fuel, whether it's food. I mean, food is already at multi-year highs in terms of fuel inflation. The wheat price is up 72% year to date. I mean, a loaf of bread, what goes into a loaf of bread? Wheat and gas, basically, to basically bake it. So wheat up 72%, gas price up 260% year to date. And
what's that going to mean for the supply chain going forward? Because let's just again hypothetically assume you're a factory. I don't know, maybe a brick maker. You consume a lot of energy. You haven't hedged it. You're having to buy spot. And essentially, in the States at the moment, the price of natural gas is roughly around about sort of $5 per metric the BTU. The equivalent in Europe spot rate for all the unfortunate manufacturers who are having to buy energy gas at spot rate is $100 per.
Oh, it's mad.
To 20 times. So what that leads is, one, it becomes uneconomical for the consumers of gas, but also you have a huge or disproportionate uncompetitive position for Europe compared to the States, because the States is obviously a net exporter of energy now.
Well, they were an exporter. Of course, if they stop buying Russian oil, then, I mean, it's going to change, of course, because they buy Russian oil. What does it mean, that competitive position? Well, a lot of those commodities you're talking about, whether it's bricks, you can't export bricks across the Atlantic. I mean, it's just not conceivable, because the cost of very heavy, hard to move concrete, stuff like that. They're regional markets. You do have imports of bricks from Europe, but Europe's worse than the UK, as you just said. What does it mean for these producers? Remember we had the problem with ammonia, and then we saw it with CO2, basically, that they couldn't produce ammonia. So then they don't get any CO2, so then you couldn't slaughter the pigs, so then you can get CO2 for beer, for soft drinks, etc., etc. The ramifications go completely through the supply chain. Either demand falls away or prices have to rise. And generally and this is what people are worried about when you read in the press talks of stagflation. The worry is that inflation goes to a level that demand falls away. Then, of course, what will happen post that?
Well, you get supply falling away. I think that's the issue. You don't just get demand destruction; you get supply destruction, because it doesn't become economic. I mean, I don't know, but I mean, what's your view in terms of what the central bankers, can they basically support $1 trillion gas market or whatever it is, multi-billions across Europe? And the answer to that is probably not now, because if they do that, inflation will just go through the roof. The currency will fall. So the only logical scenario for me, and I'd be interested to hear your views, is rationing. Is rationing. We had that in the war, and we're going to get it. We may, if it was prolonged, going to get it again, which is going to again, exacerbate the supply chain. So you're going to get demand destruction, because you and I and the dog are not going to be able to buy our utilities, but but also you're going to get supply destruction, because you're going to get rationing.
We've already got that in Germany to a degree. They're rationing. There's heating oil now. There's a shortage of heating oil in Germany. So to a degree, you've already got that. And you have it in the system already, where large energy users, you've already had it in the UK where with the grid, when large energy users get incentivized to turn off their demand if you have any shortages in the grid. So arguably, you've already got that. If prices go too high, supply and demand works. If prices go too high, demand falls. And then if you look at what we've had in the last 2 years, you've had a massive demand shock from the lockdown from COVID, which we've all forgotten COVID now, of course, but you had a massive demand shock from that. Then you had a big supply shock as the world turned itself back on in one go, basically. So then inflation picked up because you had a big supply shock. And now we've got a supply shock again, following on, which is driving inflation, as we just spoke about, whether it's oil, wheat, gas, whatever it might be. The question is, do you then get a demand shock further down the line, because prices go so high that, number one, people don't want to buy, and then demand's not there. So then you go stagflation to, recession, which is the ultimate if you do go to recession. So what can the central banks do about that? The issue they've got now, of course, is they never raise interest rates. So you still got interest rates at next to nothing.
That ain't going to make any difference at all to the price.
No, they can't.
Of gas.
They can't. Cutting interest rates make that.
Anything globally priced isn't. Local interest rates aren't going to make any difference at all.
No. So cutting interest rates. So do they go back to their well-worn vehicle of QE again? Does printing money help? Will printing money help demand pick up when prices are already high? No, you need those prices to fall. Prices have to come back to a level that people can actually buy the goods. So the central banks can't really do a lot about that. They have to raise prices raise interest rates to bring prices back, would be my view. They've got to get prices down to a level where demand and supply match. If you've got no demand, it doesn't matter what you do if the price is too high. And if manufacturers can't operate because they can't make any money, well, they're not going to run the plants and run themselves into the ground, are they? And arguably, that's where we are now. So that's the nightmare scenario that markets are trying to juggle with. Do I think that's going to happen? No, I don't think that's going to happen. I do think that it stays constrained within Ukraine, particularly as the Russian military gets degraded, like we're seeing at the moment. That will have impacts in certain commodities. It probably means much as how much we don't want to. We have to keep buying Russian oil and Russian gas, and then the world will adjust to that. And we might get a solution. The pain might become too much back in Russia. I mean, you can't. Russia now queues down the streets to get cash out. You can't buy. You've seen some of the funny memes at the moment with people saying, "I'm." Want to buy a bit of IKEA under black market IKEA sales and stuff like that. Well, that's what's going to happen in that economy. So how much pain can they take? Now, China will step in from one side, of course, and help them out. But that's an interesting scenario to look at. So if China starts buying Russian oil and Russian gas, then they won't need to buy oil and gas from the market. So that oil and gas that was going to China will go back into the market. You bring Iran back in as well. Now you're getting close, not quite to be fair, you're getting close to being back into supply and demand. And if you see a bit of fall in demand, then you're back into supply demand matching again. So then you've got to remember, oil was at 92 before this all started. Oil's 125 now. It's up 30%. That's a lot. But it won't take much if people see demand and supply coming back into equilibrium again for that oil price to be back below 92. And as we always say, the delta on markets that makes the difference. And if the prices start correcting, oil, gas, wheat, whatever, they start correcting, then the equity market will move back up very quickly, particularly in the mid and small cap end of the market, where we've seen the biggest hits to share prices.
And sort of like, which regions or sectors would you sort of like prefer at the moment, given this level of uncertainty? I mean, we talked about this. There's a significant risk, and it's been priced into the yield curve, which is basically there could be a recession. I mean, might get stagflation, but actually, if you start to get rationing, you're going to get a recession straight away. So which regions, given that the US is still off to the races and largely, and Europe is actually in a precarious position here?
Yeah. I think UK and US in terms of regions is where you want to be. I think Europe is so close that Europe is, and you've also got places like Germany and Italy that are so dependent on Russian gas that those economies are going to find things tougher. It's interesting when you ask about regions, because before the Ukraine crisis started, the PMIs, activity indicators, industrial production, it was all the stats, they're still coming out now, of course, because they're backward looking, was showing growth accelerating globally. It wasn't slowing growth. And what we're worried about? We're all worried about the Fed, the Bank of England, the ECB being behind the curve and inflation going too high. What are we worried about now? We're worried about inflation going too high, but we're also now worried about the demand side, the flip side of it. So growth was accelerating. So we had some momentum behind the Western economies. Obviously, Asia was later going into Omicron. But we had inflation. We had momentum behind pushing forward the Western economies before Ukraine hit. Ukraine's what, 2.5 weeks old now? If it's contained, if it's short, if it's long, more of an issue, I suppose, depending on what the governments do in terms of commodities that come out of Russia. But the more it's contained, the less the impact on global commodity prices, the less the impact on the rest of the world. And then we can move forward and the central banks can get onto the path of raising interest rates, getting inflation back under control, and financial markets can get back to moving normally. I mean, whatever happens now, Russia obviously remains a pariah. They're not going to come back into the global financial system anytime soon, at least with Putin at the head of it. So that's not going to happen. But the rest, Russia is a very small part of the global economy. It's less than the size of Italy. So it's going to have implications if that gets removed from the global economy, but we can work through them and we can move forward and markets can recover. So I think, that's my view. You asked earlier, can central banks support global energy markets with subsidies to the consumer and stuff like that? At the margin, governments might be able to do something, but no, they can't. I mean, you have to resolve the problem at source. And that's why you've got the EU saying today that there's rumours today they're going to do a huge bond issue for investment in defence and renewables. So moving on from what regions do I prefer, let's look at sectors of the economy that I prefer. Points I've made before about reshoring, nearshoring, capex-led stocks, totally still. In fact, it probably holds even more true now, that they are great areas to be in, because what do companies want to have? They want to have their supply chains secure. So mining capex, where's mining capex going from now? It's not going down, is it? It's going up. So Weir and companies like that, they're going to benefit. They're going to see they're going to go out there, and you might not have wanted a copper mine in your backyard 2 weeks ago. Are you going to want it now? Well, the government's going to tell you you're going to want it. So that new copper mine is going to be built. Look at what's happening in the UK. We're in that transition from oil, gas to renewables. But the oil and gas is probably going to have to last a bit longer now. And then we'll offset that with renewables expenditure elsewhere. So are we going to start drilling in the North Sea again? Potentially. Will fracking happen? Personally, I'm not a big fan of fracking, I think, but it could happen. But yeah, oil, gas, mining. Are we going to invest more in offshore wind? Already there's talk that we need more of these floating offshore rigs, wind turbines. Yeah. So companies like Weir, companies like Techmar, James Fisher that does the work to get them. These companies are going to benefit because there's more investment going into these areas, not less. So those are areas I like. And as I said, CapEx, supply chains, you're going to want to shorten those. So you're going to do that. You're going to need a new plant to do that.
And what about the other stocks you quite liked beforehand? Things like the reopening plays, overseas holidays, you're on the beach, and your banks and stuff like that. And I know you talked quite positively about it.
Yeah, totally. Well, banks you look at banks' balance sheets. Now, there's always the kind of, is there something they're not telling us, I suppose, on banks? But that's more the international banks, I would say. Have they got exposure to Russia or not? Lloyds and RBS, for example, they've arguably got the strongest balance sheets they've ever had. Are we going to see a UK recession? Well, the jury's out of that at the moment. But the balance sheets are extremely strong. They've been kind of tested till the cows gone home by the FCA in terms of stress tests and everything like that on downturns. So the financial sector has been absolutely hammered. That's certainly an area I'd be looking at because they're strong. Certainly on any bounce, those share prices will go straight back up. Overseas holidays, well, that's the question on that is consumer and the squeeze on consumer disposable income. I mean, that's got a lot larger, hasn't it, with the rise in energy prices and what's happening there. I think this year you're fine. I think people will book their holidays for this year. Let's be honest, you hear about Ukraine, you almost more want that holiday, don't you, really, than anything. You want that kind of relief of going somewhere else and going away from things and things like that. So I think this year you're fine. The jury's out on next year, let's be honest. The airlines, if you've got $125 oil, I struggle to see how they make money. That's a bit of an issue there for the airlines themselves. But the holiday companies should actually be in a relatively good position. And again, the consumer has the savings in the UK at the moment, so they do have a little bit of a buffer there. But we can't get away from the fact that they've spent. The squeeze from energy prices is huge. Food prices are going up. And that will squeeze consumer disposable income.
Okay, right. We come down to the last $64 million question. Then at the end, is the market going to be up or down when we next speak in a month's time? Because you were dead wrong last time.
Well, I was dead wrong. I said Putin wouldn't go into Ukraine, and I was completely wrong on that. But then again, I think most people were. And let's be honest, it looks like he was wrong to go into Ukraine because he's certainly not winning at the moment. I think we see the impact of Ukraine diminishing on the global economy in a month's time. As time passes, it's a sad fact, but people forget, and it becomes yesterday's story. In the absence of Putin doing anything stupid, which we all have to pray doesn't happen, let's be honest, in the absence of him doing stupid, and we've already had that first sight of a bit of, not weakness, but it is weakness, of saying, look, you can have, on Monday of him saying Crimea, 2 districts, etc. How much pain can he take at home? So we see more of that. The market will rally, and when it rallies, it will rally very hard. The market.
Well, I hope you're right. All I would say is that I think the market is pricing in a strong possibility of there being rationing in terms of industrials, simply because basically the gas into Europe is going to be limited, and if that happens in Germany, where you get rationing, and they are the manufacturing sort of breadbasket of the world, certainly of anything precision engineering, you could have some very sort of like unintended consequences. But it'll come down to a game of bluff, won't it, between the EU or NATO and Putin? Who can stomach more pain?
Yeah, and he's certainly taking a lot of pain at the moment. So, but as in geopolitics, I mean, that's the problem for markets, and the problem why markets are where they are, why they're so volatile, why any rumor either way moves them so fast, is geopolitics. You're dealing with humans and humans' kind of nature, and who knows what they're going to do next. And you've got someone who arguably has behaved irrationally already. So what's he going to do next? It's almost impossible to predict, to be fair. But the one thing, if you've got positions in the market, it's not the time to panic. I mean, companies I would look at in general, rather than just specific companies, you want strong balance sheets. You want to be in those areas where you're seeing secular growth, where you've got good management who've proven themselves, because they're the companies that will have the systems in place and the reporting systems in place to be able to manage their way through this. I think over-indebted companies, we've already seen it in some cases, they're the ones where the banks are more likely to go, I'm not willing to take this risk anymore. Sorry, but we'll pull the plug and we'll realise those assets or whatever they might be.
Yeah, well, I'm with you. I think if you've got a reasonably long-term time horizon, eventually this will end. Commodity prices will come down, and the world economy will adjust. So it all depends on how. You just got to basically prepare that you're going to have to wait for your returns a bit longer. And this year may see a lot more downside on the short term, but you may see more upside going forward. And if you're not investing on margin, then you're never going to become a distressed seller. So you should be okay longer term. Yeah. So
totally agree.
Thanks very much then, Jamie, and look forward to getting in touch with you next week.
Thank you. Cheers. Bye.